8 to 9 in the morning, little plug for Bloomberg over here. There's so much to talk about given the uncertainty in the global environment and, of course, most recently the drop in oil prices. So we're going to be talking about that and the outlook for the region. But before we do that, I would like to invite the COO of DIFC, Alya AlZarouni, to come up and give a few opening words. Of course, we are having this panel in the DIFC. The floor is yours.
Good morning, ladies and gentlemen. On behalf of Dubai International Financial Center, it is my pleasure to welcome you all to the launch of the IMF Regional Economic Outlook Report for the Middle East and North Africa region. It's a great honor to have you all here today as we gather to discuss the economic landscape and the future prospects for our region. As home to over 6,900 active companies and more than 46,000 professionals, DIFC plays a key role in shaping the financial services ecosystem of the region. We're also proud to act as a platform that fosters meaningful dialogue between public and private leaders and supports knowledge sharing when it comes to economic trends that impact our region. I'll make it really very short. I just want to take this opportunity to extend my sincere gratitude to the IMF team, to Dr. Jihad Azur, Director of the Middle East and Central Asia Department of the IMF. Your reports are always a valuable guidance for us as policymakers and stakeholders. Thank you all for joining us today once again, and I look forward to the insights from the panel discussion. Thank you.
Thank you so much. Thank you. So the title of today's panel is Charting a Path Through the Haze, and certainly the world is experiencing a bit of a haze right now. Most recently, the IMF revised down projections for global growth by 0.4% since last October, with growth in the US also expected to slow by 1% versus last year. And of course, a lot of the uncertainties are stemming from the global growth environment. There are questions about trade policies, about the impact of tariffs, and of course, as I spoke about more recently and more pertinent, I would say, for the region, is lower oil prices. So we will discuss the outlook for the region, the direction of travel for oil prices, how the private sector is responding. So let me introduce our panelists. A man who doesn't need introduction, Jihad Azur, Director of the Middle East and Central Asia Department from the IMF. To his left, Halima Croft, Head of Global Commodity Strategy and MENA Research at RBC. To her left, we have Tariq Youssef, Director and Senior Fellow of the Middle East Council on Global Affairs. And to his left, Ahmed Galal Ismail, the CEO of Majid Al Futtaim Holding. A little bit of housekeeping. We're going to be having a panel discussion for about 45 minutes, and then I'm going to open up the floor to questions. There will be about 10 to 15 minutes worth of questions where you'll get an opportunity to ask questions, so put up your hands if you do want to ask a question. Also, as ever, because we're all on social media, if you want to tweet about it, you can tweet with hashtag IMFMENA. Okay, so that's it from me. Jihad, let's start with you. In your latest regional economic outlook, you say that growth in the region is projected to strengthen in 2025 and 2026, though by less than October. So first of all, why the downgrades versus where we were in October? And second, how do you break it down by the regions or the different segments that you identify in the region, i.e. you've got the GCC oil exporting countries, you've got the non-GCC oil exporting countries, you've got the low-income countries. How do you see it spread out?
Shumana, thank you very much. It's a great pleasure to be back here in Dubai for the launch of our outlook. It's always an opportunity to exchange on the priorities for the region. Well, no, of course, in time of uncertainty, you have to start with a point that you know about, okay? Let's start with the facts. 2024, 2025, we are projecting that the economies of the region will grow. The growth is going to be differentiated between different segments of the region, and I'll go back to that. But clearly in 2025, we project the economy to grow by 2.8, and next year will go up to 3.6. Why have we downgraded our projections? We have downgraded our projections because of the high level of uncertainty. The global uncertainty, although it's not directly affected the economies of the region, and I will come back to that because I think it's an important point. It's an important fact to analyze, but is having a certain number of indirect impact. Therefore, this with the regional vulnerabilities as well as also uncertainty led to a revision downward revision of our projections for 2025. Also, the evolution of the oil market. This also contributed to the downward revision of our outlook for this year, and the risk of increase or the risk of hikes in interest rates. Therefore, the first fact is the economies are growing, but the level of growth has been revised downward to take into consideration all these shocks. The second important element is this diversity is not only related to the nature of the economies, but also countries are performing differently. In the oil sector, you have the GCC economies that are performing better than the non-GCC oil-producing countries. A country like the UAE will grow at 4% this year, and this growth will accelerate next year. Same for Saudi Arabia. Therefore, GCC is performing better than the average growth in the economy in the region and better than the other oil exporting countries. Among the oil importing countries here also, I think it's important to separate. Among the EMs, you have countries who, thanks to their strong macroeconomic management, have been able to withstand shocks and through acceleration of structural reforms to maintain good level of growth. For example, a country like Morocco. Countries who have high level of debt are now subjected to an additional pressure, which is how to service this debt with increased interest rates. And the third group is a group of countries in fragilities. You have some countries with, I would say, certain hopes, Syria and Lebanon, where a potential reconstruction could allow those economies to recover. Others are still suffering. Therefore, it's an economy that has been responding well to the various uncertainties and shocks, but the vulnerabilities are growing. And this leads me to the second important point that I wanted to make in terms of, I would say, putting the backdrop. The point of how uncertainty is affecting this region. Uncertainty is affecting this region, although the level of integration and trade with the US is limited, and the oil sector has been excluded. Therefore, maybe people would say, okay, we're not affected, and therefore nothing to worry about. No, there are impacts, and those impacts are multiple. The first impact is the impact of uncertainty on the oil market. Demand may drop globally, and we already saw softening of the oil market, and the forward prices of oil are showing that we will end the year at a lower oil price than the beginning of the year. Second, we saw high volatility on the markets, which has led to widening of spreads. For certain countries, the spread widened by more than 120 basis points. Therefore, we have to take into consideration that there is an indirect impact on the market. The third impact, and an important one, that we're seeing is there will be reaction to those trade measures, and there will be redirection of trade, and those redirections of trade could have an impact on the region. Is the region totally deprived from capacity to respond? No. I think, and this is something maybe we could discuss later, the region has the capacity to adapt, use those transformations as opportunities maybe to redirect its economic relationship, also to strengthen regional integration and integration with other parts of the world, and three, activate policies. In the outlook that we are releasing, we show that extended uncertainty has a negative impact on growth. That could be, even if you let it go for example, 2 years, it could drop your growth by 4.5%. Therefore, it's an important element. This requires to have active policy response. Waiting to have better clarity on the global economy outlook is not the right thing to do.
Hope is not a strategy. Let's talk about one of the vulnerabilities that you brought up, and that is oil prices. Luckily, we have an oil expert with us on the panel. Well, it's been quite the month for oil. We were talking about it on the show earlier today. Throughout April, oil prices dropped 17%. This was the worst monthly performance since 2021. And if you rewind back to the beginning of April, there were perhaps twin catalysts. You had the tariff announcement out of the Trump administration, followed up by a surprise announcement by OPEC Plus to accelerate and bring forward the total amount of production and bring extra barrels to the market. That came as a surprise, a negative shock. So put into perspective for us what has happened over the last month and how you see the supply drivers, and given that we also have another big OPEC Plus meeting coming up in May 5th, and of course, President Trump is coming to the region in a couple of weeks' time.
Thank you so much, and it's so wonderful to be here. I would say, even before President Trump took office, there were concerns about the oil price outlook for this year. I mean, Chinese growth, demand growth had been underwhelming for 2024. When we looked at the supply picture for 2025, and you looked at what was expected to be fairly strong non-OPEC supply growth, not just the United States, but also Canada, Guyana, projects that are not short cycle, we were concerned that you would have an oversupplied market. And so that put a lot of question marks around what would OPEC do? And what would the Trump factor be when it came to policy that could impact the demand side? And what we are seeing now, as you mentioned, in April, the twin announcements of Tariff Liberation Day, which I think caught market participants by surprise. I don't think a lot of market participants were fully expecting the tariff rollout that we saw that day. And it really sparked another wave of concerns about what is the demand outlook going to be. And then you had the surprise announcement of the voluntary producers, the countries in the V8 of OPEC that were making additional voluntary cuts to accelerate the supply they would bring onto the market. They basically wrapped 3 months of increases into 1 month, and all of a sudden, it triggered the fears of that November 2014 meeting, the Thanksgiving Day meeting, when OPEC made the decision not to put a floor under prices, and we got the year-plus war against shale that ended when you had OPEC come together with Russia and other producers to start balancing the market again in 2016. And it also brought concerns about March 2020, when you could not reach an agreement and you had that brief price war between Saudi Arabia and Russia. And because you have those moments in the market, you've had this concern always lingering that at some point OPEC would make the decision to stop balancing the market, to essentially not give non-OPEC producers a free pass to increase production, that they would essentially say, over to you, non-OPEC, you balance this market. So obviously that is, the twin factors are putting a lot of pressure on prices. We're going into a very important meeting on Monday where we're gonna get another announcement of what we can expect from the voluntary producers. Many are now anticipating in the market further accelerated increases because several of the countries that have been cited as non-conformers, most notably Kazakhstan, has not been able yet to bring their production down to the target. So there's an expectation of more supply coming onto the market. The one thing I would say, clearly I think the balance of risk in the near term is weighted to the downside. We still have to pay attention to other stories like what's happening with Iran, what's happening with sanctions, military strike. But what I would say just from a market fundamental perspective is I don't think we're there with the 2020 or 2014 analogy, because right now it is a relatively modest increase. It's not a full turn of the taps. And I think that is important because you can move lower in prices but not have a major inventory glut that you have to work off. And that was a big challenge for OPEC in 2016. By the time they started managing the market, they had to work through so much of an inventory overhang. It was a very arduous task to bring the market back into balance. Moving prices lower without a big glut in terms of inventory does make a policy correction easier, even though prices may move lower in the near term.
Halima, just as a quick follow-up to that, because you have been following OPEC for so many years of your career, what do you think prompted this shift out of Saudi Arabia to start thinking more about market share as opposed to stabilizing prices?
You know, I think from the standpoint of Prince Abdulaziz, I think he's always been somebody, the Saudi oil minister, His Royal Highness, he's always been, I think, an advocate of market management, but he also has the principle that everybody must carry their weight. He does not like the idea of free riders. And so I think what we saw, even over the summer, we got, views that countries that were not reaching their targets, that the Saudis could potentially sunset their 1 million barrels a day quickly because they were not prepared to carry the non-conformers. And so there's, Kazakhstan has been the country, it's an OPEC plus country. They have certain challenges in terms of shutting in their production because international oil companies operate there. There's a one key field, Tengiz, that has been expanded, which is adding to the supply picture for Kazakhstan. So it's an uncomfortable conversation for that government to shut in production. That has been the country everyone's most focused on. But again, are there other issues that are at play? That remains to be seen. Maybe some countries want larger market share. We have a Trump visit to the region. But I think for the Saudis, the principal issue is getting everyone to carry their own weight.
Okay. Thank you for the perspectives. Tariq, let me bring it back to you because we've discussed in detail one of the vulnerabilities to the region, and Jihad gave the IMF perspective on different pockets of growth and challenges also, if you break it down by the different blocks. From your perspective, how well equipped do you think the region is to deal with some of these global uncertainties that we mentioned earlier?
First, I do agree with everything that has been already said, and I'd like to build on some of the things Jihad had specifically spoken about, which is trying to differentiate the short-term impact of the dislocation we've seen, which I agree has been limited, muted, and can be contained. Differentiating that from what is likely to happen over the next year or two, and I'd say this is where the uncertainty piece, which the IMF regional report does an excellent job of explaining, unpacking, comes in. It's an uncertainty of a magnitude we have not seen in a very long period of time. And to the extent that involves a lot of dislocation, a lot of volatility, not just in financial markets and oil and growth and inflation, but also monetary frameworks and interest rates and supply chains. That raises, I think, the question, Jomana, you're asking is, who in the region is equipped to manage things over the next 12 months, the next 24 months? And keep in mind that President Trump has only been in office for 100 days and has inflicted quite a bit of uncertainty, and I would say also damage on sentiment, confidence, and trust in the international system. How much of this can happen in the next 3 years is something for all of us to contemplate and reflect on. But thinking about who in the region can, in fact, respond and adjust. And it pains me to say this, but as many IMF regional reports previously have emphasized, we're talking about multiple sub-regions within the region. We're no longer talking about an economy of the Middle East, or even the economies of the Middle East. The Gulf is a distinct set of countries subject to their own dynamics, showing a lot of dynamism and growth and confidence, stable institutions, predictable frameworks, and a set of policies that prepare them, I would say, to manage the uncertainty beyond the next few months. They also happen to be in a position to negotiate. They have some of the cards, so to speak. They can sit down with the current US administration, offer some bargaining chips, make deals. The very personalized and transactional nature of policy making in the coming period between the US and the Gulf countries, I think, puts them in a favorable position. That's not true for the rest of the region. And it's not true especially for a group of countries that we're stuck with. Countries in conflict zones, vulnerable to conflict. Countries that are constantly managing crises. There are questions about institutional integrity, about policy cohesion. Jihad has already alluded to some of the vulnerabilities they have in debt, exchange rate management, interest rates, inflation, food security, climate change. The non-conflict countries of the rest of the region have a lot of work to do. And it's not clear to me that they can manage this without potentially being subject to too many shocks, facing too many vulnerabilities, and including, and not limited to, social unrest and macroeconomic crisis. Then we're left with the conflict countries, many of which now can be easily and conveniently labeled failed states, countries where you may not have fighting, but you don't have resolution. You may have a ceasefire, but there's no government that is actually exercising sovereignty. This group of countries was already facing a lot of problems. To add to it, the magnitude of dislocation, uncertainty, and remember, we're not just talking about economic uncertainty, we're talking about potential geopolitical uncertainty being heightened in the coming period. After all, what is coming out of the US has a lot to do with the rivalry with China. Then it has to do with simply protectionism and tariffs. The two go hand in hand, reflect the same impulse, the same drive, and it's the same policies that I'm afraid could render many of the conflict zones in the region much more prone to a relapse of conflict, the emergence of regional geopolitical competition once again, and could affect the neighborhood, but also the larger neighborhood, including the Gulf countries, which for the last decade have benefited from their stability, predictability, and peace within.
Ahmed, I was looking at some of the US data that's emerged recently. US consumer confidence numbers came out at a 5-year low. You've had some companies pull guidance the last few days because they just don't have certainty about the outlook. They can't give guidance. And I just wonder whether you're seeing signs that consumer spending in this part of the world is about to slow down.
Well, let me first build on everything that's been said. I agree with my colleagues here. There is plenty of uncertainty, but there is also some certainty that we have. And the region is a very, I would say, mosaic region now. And the report rightly differentiates between the oil producers and the non-oil producers. I think within the oil producers, if you look at the UAE specifically, it's important to actually acknowledge the exceptionalism of the UAE economy. It's one of the very few economies in the world that managed to transition from a mid-income to a high-income economy, escaping the middle-income trap, and at the same time, one of the very few economies that managed to diversify the economy to 75% non-oil GDP. So within the UAE, 2024, first quarter of 2025, and I think for the foreseeable, near term, consumer confidence and consumer spend continues to be quite robust. And with plenty of uncertainty in the region and plenty of uncertainty in the globe, the UAE could be a net beneficiary of some of that uncertainty. You see more capital, you see more businesses, more people choosing to base themselves out of the UAE. So I think the outlook for the UAE is quite robust, despite the multiple uncertainties that we see. Outside the UAE, in the GCC, Egypt, and elsewhere, 2024 already hasn't been a great year for consumption. It is true, and I think the report makes the point very clearly that consumption and investment has accelerated post-COVID. But last year, most consumers in the region have had a situation of relatively high inflation, relatively high funding costs, big devaluations in many of the markets that depends on import that have actually affected the cost of living. You've had the geopolitical events that have weighed down on sentiment as well as spend. So that recovery, it started to happen in the first quarter, and with the uncertainty that we see around us now, looks a bit shaky across the region. I think at the micro level for the private sector, there are still opportunities. And maybe let me illustrate that at the most micro level possible. I mean, this bottle of water. I'm not sure what the economics of this bottle of water is going to be over the near-term horizon. If it's an important bottle of water, it would certainly perhaps cost a little bit less with oil being subdued to bring into the country. With a weaker dollar, it might be a bit more expensive. And certainly what we see here, and actually this is a good example of that strategy for the private sector, it is a local bottle of water, okay? So it doesn't matter if the dollar moves or oil price moves. And I think for the private sector, there are multiple opportunities in the region. One, around localization of talent, localization of supply chains, localization of the business, I would say, setup. Two, I would say, is regional integration. The region still is fairly fragmented, and the private sector can lead on promoting regional integration that preserves the business from external shocks. And I would say the third is to build buffers. And perhaps the comforting bit for the region today versus maybe around COVID time or going back to the global financial crisis, the balance sheets of private sector players in the region today are a lot stronger than they ever was, in previous cycles. And the balance sheets of the banks and financial institutions are also quite robust. And you've seen the ability of private sector players to tap the regional and global debt capital markets and raise significant amounts of money at fairly, I would say, compressed yields. So plenty of uncertainty, but also some opportunities for private sector, especially here in the UAE.
Jihad, let me turn to you and specifically talk about some of the work that the IMF is doing with countries that don't benefit from the same fiscal buffers. And obviously, lower oil prices are going to challenge some of those fiscal buffers for oil exporting countries. But then, Egypt is in a program. There are discussions going on with Lebanon. You've re-engaged with Syria once again. So just talk us through the IMF's role in this time of uncertainty for countries in the region who need it.
Well, the IMF is actively engaged in the region. We have in the last 4 years mobilized more than $47 billion of financing to the region. But more importantly, also we have scaled up our capacity development, which is the advice that we give for countries. Let me start with countries where we have programs, and I think it's an important starting point. We have programs with countries like Jordan, Egypt, Morocco, Mauritania, and a few others. And I would say those programs over the last few years helped those economies stabilize, withstand shocks that were not easy. Jordan, Egypt were faced with the implications of the war in Gaza that affected, for example, tourism in Jordan and the revenues of Suez Canal in Egypt. And yet, when we look at the performance of those two countries, and despite those shocks, those economies are faring relatively well, those shocks. Inflation has come down in Egypt and growth is gradually improving. And Jordan, that has been subjected to external shocks, is resilient. Morocco is a country that kept doing reforms and now is one of the countries who benefit from our precautionary facility, which is something we give for countries who have strong fundamentals. Therefore, clearly the programs that we have in the region are helping those countries, and not only in terms of catalyzing finances, but more importantly, guiding reforms. The flexibility of the exchange rate in Egypt is one important development that allows Egypt to go through a very challenged 24 months with limited impact on the stability of the economy. What those countries need today is to maintain the course of I would say one is to remain vigilant on what has been achieved. Stability has been achieved, but stability is not enough. We need to accelerate reforms. Take the case of Egypt. Clearly today, the private sector has still potential to grow. And for the private sector to grow, has to be supported by the public sector. And for the public sector to support the private sector, the public sector should get away from being a competitor to the private sector. And this is why divestment is very important in Egypt, leveling the playing field and allowing the private sector to attract further investment from in Egypt and abroad. This is, for example, what Egypt could do in the next 12 to 24 months. Keeping inflation under control is also something that is priority for Egypt. It gives predictability to the market and allow private sector also to do business relatively well and reduces the social pressure. A country like Jordan, like other countries, are now also faced with a new challenge, the drop in ODA. Jordan is an important recipient of ODA, and the drop in ODA has had a negative impact on most countries in the region, but more importantly, in countries in fragility. And the policies that have been introduced in Jordan over the last couple of years help Jordan, despite all these shocks, to remain stable, improve the level of growth, and even get upgraded by rating agencies. This is the first group. The second group of countries are countries who are doing well, but where also they can still do better. Our engagement with countries in the GCC has been expanded. We have now a regional office based in Riyadh. And what we do with the region is to look at the new generation of reforms. Some of those reforms will improve the competitiveness of those economies, increase integration within GCC where we still have potential. Financial deepening, trade integration are areas where the GCC can grow itself as an emerging global power. 3, connectivity. Connectivity, for example, with Asia, Central Asia, ASEAN, with Africa, North Africa. Therefore, integration has now a new meaning, and it helps address the risks that are emerging because of fragmentation and fragility. The last but not least is an important group, is the group of countries in fragility. The Lebanon, the Syria, countries who are emerging from highly difficult situations and need support. And the support, and here I want to underscore, it's not by providing only financing, is to handhold those countries to move from a situation of despair to a situation of stability and later on of prosperity. This requires a multi-pronged type of work, stabilize the economy, build institutions, and provide assistance. And this is, for example, what we are doing with Syria. Last week we had a roundtable on Syria, and also this is what our team is doing with the Lebanese authorities, helping in designing the reforms and also providing them with assistance. Therefore, the role of the fund is more important than ever, and especially now with the uncertainty is an important moment where we need to understand that uncertainty requires action, not wait and see. Requires building buffers, requires also trying to understand how those winds are moving and where the region should be in the new order that is emerging.
Thank you. Halima, let me ask you about the intersection of geopolitics and energy markets, because we spoke earlier about some of the demand drivers, supply drivers, but I also bear in mind that this is a region that's also quite sensitive to geopolitical discussions that are going on around the world. There are discussions going on between US and Iran right now about a potential nuclear deal. Also discussions around a potential peace deal, potentially, between Ukraine and Russia. How are all of these discussions being factored in to your own forecast of where oil may end up this year? How do you see the different scenarios playing out?
This is such a great question because I talked about everything that represents the sort of near-term downside risk. But if you ask me on the other side of the ledger, where do we see the potential for prices to rise? Where's the event risk to the upside? And I would say Iran bears very close watching because President Trump is very focused on trying to get a new deal with Iran. And that is different than Trump 1. Trump 1 was very focused on the maximum pressure sanctions campaign. There were people in the administration who wanted military action. President Trump has seemed to have shifted a bit in terms of saying, I want a deal. But the challenge is really what is going to be the US offer to the Iranians? Because while the Iranians, I think, are willing to take a deal that looks like the 2015 nuclear agreement, whereby which Iran would enrich at low levels of uranium, 3.67, consistent with the civilian nuclear program, allow more robust inspection regime, forego using certain high-speed centrifuges, push out the timelines by which they can restart nuclear activities as sunset clauses. Well, they would agree, I think, to something like that in return for sweeping sanctions relief. What we don't think they will agree to is the Libya option. And the Libya option is what we saw after the US invaded Iraq, and the Libyans basically put up their hands and said, if you're going to invade a country with no weapons of mass destruction and we are sitting on a nascent nuclear program, we may want to come in from the cold. And the Libyans essentially handed over all of their infrastructure related to the program to the United States and essentially told us how they acquired the technology. It's how we found out about the AQCon network in Pakistan. And so right now, there's a segment of the administration and a segment of Congress that is pushing for a essentially shut it down, ship it out agenda for Iran. And there's no indications that Iran, having lost key proxies like Hezbollah and Hamas, are willing to essentially ship out their centrifuges and shut down their program. Now there's a third path we've heard about, whereby which the Iranians maintain a civilian program but import the fuel for their reactors, a sort of UAE option. But again, remains to be seen whether they would take that plan. And the challenge is that if we get a deal, there is a prospect of sanctions relief, but it would have to go through the US Congress. And I would remind everyone that the bulk of the sanctions architecture on Iran related to energy and related on things like bans of equipment to Iran Air, that was all done through Congress. So Congress would have to approve a deal. But if we don't get a deal, that raises the issue of more strengthened sanctions and possibly military action. And everything we've been told is that this is coming to a head very soon. This is not going to be an indefinite, prolonged period of negotiation. So we're watching where we are come June. I think we'll be at a very important inflection point. And when it comes to Russia-Ukraine, there was a lot of expectation when President Trump took office, because he wanted a deal quickly, that you would see Russian molecules returning to Europe and the removal of sanctions. Again, far from clear that we're there yet. And I also would say when it comes to sanctions on Russian energy, some were done by the US Congress, so again would require congressional approval, but the bulk of the sanctions architecture on Russia related to energy, that was implemented by the European Union. So the ban on Russian seaborne oil imports into Europe, done as part of the sixth package of sanctions. The price caps came in response to the sixth package of sanctions. So the question is Europe going to be willing to go along with a deal that is seen as overly generous to Russia? So Europe really has to have a seat at the table to get fulsome sanctions relief on Russia. And last thing I will say, I'll wrap it up, is that I see some contradiction between President Trump's negotiating tactics with Europe, essentially saying, Europe, as part of the tariff negotiations, we want you to take more US LNG. At the same time, Russia will demand market access back into Europe as part of a peace agreement. So how do you square Russia's desire to regain its most valuable market with the Trump administration's push for market access for US exports into Europe?
Excellent point. Tarek, let me turn to you now and actually ask you about the third segment that Jihad was referring to, which is the countries that are in perhaps most need of help, emerging from conflict. The reconstruction needs are huge. How do you think about not just the role of rebuilding institutions in those nations, but also the role of the international community? What conditions need to be there on the ground in order for those reconstruction funds to come back in?
I would start by saying first that the international community doesn't have a very good record of helping countries resolve conflicts and transition from conflict conditions to post-conflict reconstruction, at least in our region. I think the international community has done a good job generally of securing ceasefires, engaging in prolonged, protracted negotiations, offering carrots and sticks, bringing warring parties to achieving a ceasefire, and to perhaps agreeing on some sort of a power-sharing agreement for governance. Unfortunately, these ceasefires and power-sharing agreements have created frozen conflicts. where a government is ineffective, warring parties are now engaged in criminal activities, there's no protection for resources, corruption runs rampant, and the prospects of a transition to a more normal, functioning, sovereign state with sound institutions does not happen. I would say the onus now, as we think about it, and two cases I would cite that are obvious to all of you, Libya and Yemen, ceasefires that have been around for a while, but everyone thinks these are failed states effectively, facing the prospect of a partition, no less. Syria has made us cautiously optimistic recently in how it has managed at least some of the security questions inside the country, how it avoided the possibility of having a divided government that is unable to make decisions, and where the rush to election, usually at the behest of the international community, ends up creating polarization and driving the country towards conflict. Syria is making us cautiously optimistic, but Syria could use a lot of support from the international community. Not support in telling the Syrians what to do or how to do it, but support in doing some very obvious things that the Syrians need, and the international community appears to be dragging its feet about. Sanctions relief, not full sanctions relief, limited, targeted, the power sector, payment of salaries, encouraging donor agencies, not to provide the money because there's a short supply of this now, but to provide the capacity building and the technical assistance, what the IMF has called laying down the foundations for a functioning state and a market economy. I think we need to go back to the drawing board, especially now given the uncertainty we're dealing with about the responsibilities and the role and what the international community is prepared to do or not, and start organizing the steps in international support for stabilization and reconstruction to respect sovereignty, to support capacity and institutional building, protect resources, draw a line on corruption, and more importantly, where possible, ensure that a country like Syria, for example, does not fall prey to potential security vacuums that become an invitation for regional and international interventions that undermine Syria, undermine the neighborhood, and take us back to the decade of rivalries, competitions, which were a lose-lose for everyone.
Ahmed, the Trump administration has been pretty clear that they want to rewire the global trading system. And I want to draw on something that Jihad mentioned right at the top, which is that maybe this region, or at least the GCC, could stand to benefit from a redirection of some of these trade flows and trade corridors. How do you see it from your perspective?
I do think that there are a couple of interesting, I would say, dynamics to be mindful of, to think about some of the potential opportunities, notwithstanding the extreme uncertainty. I think one is the center of gravity of global trade and capital flow for a number of years now has been moving more and more towards this region, and specifically the UAE. So that in itself creates multiple opportunities in this regard. And you know, trade is like a flowing river. You know, you put one obstacle or one dam, and the water finds a way around it, and it's usually the path of least resistance. And certainly the region here, because of the trade infrastructure that exists, physical trade infrastructure, as well as the number of free trade agreements that exist between the UAE, GCC, to a certain extent Egypt, and many parts of the world, as well as, I would say, the open ease of doing business environment that you have here, you would see that many global and regional business, for them, the UAE and the GCC becomes the natural choice to rebase and rethink their global supply chain. So I think that creates certainly opportunities. I think the other opportunity is also on terms of productivity. From a private sector perspective, our economies have been growing albeit at slower rates, according to the report, because of a lot of investment of capital, some by the government, some by the private sector, a lot of net immigration and population growth. Productivity-led growth in our part of the world has been minimal for quite some time. And with the advent of technology and AI, there's a big opportunity for the region to leapfrog. And again, that goes back, I would say, to a structural advantage that we have here in the region, is that tech and AI is both capital and energy intensive. The region has very strong balance sheets, as well as access to the reserves through sovereign wealth funds and others. And in terms of energy, we are home to the cheapest renewable energy feed anywhere in the world, as well as the lower cost production of traditional hydrocarbon energy. So I think the combination of access to capital and access to energy, and again, faced with uncertainty and with the cost of technology rapidly coming down, and with the region also potentially having access to technology from both sides of the world, could position really the private sector as well as the economies overall for once in a decade, perhaps, opportunity.
Nice to end the panel on a positive note. I'm going to open it up to questions now. We have a question from the front. Yeah, there should be a microphone coming to you, yeah.
Thank you so much for the esteemed speakers. My name is Serge. I am a member of AlZarouni International Public Movement. As mentioned by Mr. Jihad, recently the Economist Journal as well coined a term for Trumponomics as the new world disorder. So definitely Mr. Trump is trying hard to make our hearts beat faster. Mr. Tariq, you mentioned that we, part of uncertainty, we face another challenge, is the climate change. And we see tornadoes, floods, and NASA scientist Egan Chalakian says that it's an alarming, rising exponential trend. So my question is probably to Mr. Ahmed. Considering the recent situation in Spain with electricity and the experience in Dubai last year with the flood, how prepared is the city in Majid Al Futtaim to this heat that we see right now and to possible extra rain that might come? And what conclusions and like preparations were made considering last year's experience? Thank you.
So it is absolutely true that the world is getting warmer, and our part of the world is warming up twice as fast. So for every 1.5 degrees increase in global temperatures, the region's sort of temperature rises by 2 to 3 degrees. And that is something that I think has been well embedded into the policymaking framework here in the UAE and in many economies in the GCC. And there has been significant mobilization of investments to deal with the inevitable rise in temperatures. From a corporate perspective, we see sustainability more as a trade-on rather than a trade-off. So the more sustainable our real estate assets, and our real estate portfolio is one of the most highly rated sustainability ranked asset portfolio in the world, the more that it is more efficient to run, the more pleasant it is from a customer experience perspective. And on the back of that, we've been able to raise at least 5 to 6 billion of green financing to fund some of the, I would say, adjustments we've had to make in our assets. So I think the GCC and the UAE are well prepared. Elsewhere, there's a huge funding gap that everyone is aware of. And perhaps the blessing in disguise of these extreme, I would say, events is that it would finally perhaps make the case clearer for action and for mobilization of the required financing to deal with the inevitable consequences.
Other questions?
Hi, everyone. My name is Dina. I'm from Control Risks. My question is, how is this uncertainty that you guys spoke about impact the local currencies pegged by the dollar?
Is that a question to Jihad?
Yes.
Okay.
Well, there are different exchange rate regimes in the region. Those exchange rate regimes need to be activated when crises occur. Let me start with the one that prevails here, which countries are having currencies that are pegged to the dollar. I would say where risks are, okay? Most of the export in the region is denominated in dollar, including in certain countries, even the billing process is done in dollar. The softening of the dollar would not really have an impact on them because of most of their trade is dollar-based. It could have a positive impact on certain service sectors like tourism, for example, where we will see some maybe more potential to attract additional tourists. What is needed in those cases is to make sure that you grow the foundations of your competitiveness. I think one issue was mentioned is the issue of productivity. Increase in productivity, increase in your capacity to be competitive will allow you to become less affected by currency movements. For countries who have flexible exchange rate, the flexibility of the exchange rate offers an opportunity to be used as a way to address the growing risk that could come from uncertainty. I would say, and allow me to broaden a bit my answer. In time of uncertainty, buffers are very important, but also the coordination of policies. You have to make sure that your fiscal policy is well anchored, and then also that the coordination between monetary and fiscal is done in a way that you don't increase your weaknesses. And those who have a flexibility in the exchange rate, they need to make sure that also it's being put at use in order to reduce the impact of external shocks. We saw this in Egypt, for example. The last 12 to 24 months were a period where Egypt was subjected to external shocks, and the flexibility of the exchange rate allowed the market to adjust faster, to have a stronger convergence between market rate and official rate, and to provide access to foreign currencies to the private sector, which reduced the level of uncertainty that the private sector had, for example.
Any other questions? Yep, one over there.
Sorry.
Good afternoon. Good afternoon, ladies and gentlemen. Can you hear me okay? Perfect. It's more of an open question to the panel. So based on today's lesson, or based on today's panel, what would be the takeaway lesson for the businesses that have a global presence in the world, and especially in this region, and would there be a further downfall to the businesses? And it's more of an open, for everyone to chip in.
Okay, let's park that question. We also had another lady stand, and then I'll put both of them to the panel at the same time.
Yes,
Please.
hello. My name is Benedict Hannebo. I help companies transforming their go-to-market.
We can't hear you, sorry.
Yeah. So the question that I have is that there is a say that every empire starts and finish, right? We say British, that was the 19th century, Americans, the 20th century. Do you see the American administration with their current actions accelerating a potential decline? And if so, what would be the impact for this region and for the wider East region?
I'm not sure I heard the question correctly. Do you see the actions of the American administration
accelerating a potential decline of America as being, the biggest economic power?
Okay, so maybe let's pose the business question to Ahmed, and we can take the second question to Halima.
Question, sorry.
About global businesses operating within the UAE.
Yeah, I mean, that's a long-term trend. I mean, you look at DIFC, we're here in DIFC, you look at when DIFC was established some 20 years ago, and you look at DIFC today, it's an outstanding success story. So I think with global uncertainty and with the continuous, incremental improvement in stability and infrastructure here in the UAE, I think that's a one-way street. More and more, I wouldn't say even regional companies setting up business here, but you see entrepreneurs, global companies choosing Dubai, the UAE, and Abu Dhabi as global centers of operations. So I think that is a trend that's here to stay and potentially accelerating. I think what that does for the broader region is also net positive, because if the region continues to come together in a more integrative way, bringing more investments, talent, etc., to global cities like Dubai, you would actually have a spillover effect on the rest of the region. You would see that companies that come and set up business here in Dubai, they suddenly want to look at nearshoring some of their activities, nearshoring some of their manufacturing, and that is a natural synergy with North Africa, for instance, as well as Pakistan and India. So I think it's net positive for the UAE and certainly for the region.
And I'll take the question on the potential end of American empire. I love that question, and I have a favorite book called Our Man, Richard Holbrooke and the End of the American Century. So I really do think, from the Clinton administration, there has been this debate over America's leadership role in the world. And I think you see both the Democratic Party and Republican Party divided on this issue. And even under Obama, there was a debate over, is America the essential nation? And I think the Trump administration is very transactional. And so for this region, there are deals to be done. There are good relations that President Trump has with leaders in this region. But I don't think the guiding principle of this administration is American leadership globally. And I think the real question is, what then replaces that? And are we going to see, is this the story of the rising, China story? And are nations in this region and in other parts of the world very much hedging their bets by essentially saying, we will maintain relations with the United States because we need a transactional relationship on defense, on things that you want commercially, access to chips for AI, we want your Boeing jets. But when it comes to trade relations and where they see their economic future, many countries in this region will say, our future is in the East. So United States, don't expect us to support you if there's a UN vote on Taiwan, for example. So again, I think countries around the world are hedging their bets in terms of making sure you maintain good relations with China as well as with the United States.
I would like to add one point that covers both comments or questions. There are countries who are movers, like the US, large powers, and there are the receivers. Most of the countries of the region are receivers. But it doesn't mean that you don't need to act. Let me take an example that we all still have in mind, a moment of high uncertainty. The COVID crisis, at the beginning of the COVID crisis, we didn't know anything, and we were faced with a huge set of challenges. I think what this region and this country specifically showed that acting fast, setting priorities, and trying to very quickly move based on the institutional framework that you have, address some of the weaknesses, helped accelerate the recovery outside one of the most challenging crises that they went through. This level of this uncertainty is different, but it requires also active management. The sources of uncertainty is coming from certain number of macroeconomic policies that could affect your resilience. Therefore, first thing to do is build buffers in order to strengthen your resilience. Second is to have the capacity to navigate when you don't have a GPS, which means that you have to rely on your competence, strengthen your capacity to decide and to decide fast. Three, think the unthinkable and plan for it and act very quickly. There are certain number of reforms today that are very much known and needed. Deepening the financial integration in the GCC. This is something that would enlarge the market, reduce even the impact of external shocks, increase trade integration. For example, here and also with other parts of the world. Those are moves that will allow you, when things will normalize, to be among the first to benefit from it. Therefore, I think what we are trying to emphasize in this report this year and focusing on the issue of uncertainty, uncertainty calls for action, not for waiting to see how things unfold. Those who wait would face higher risk than those who move fast. And moving, we have at least a fair long list of things that countries need to address, and this is an opportunity to do it.
That was a good question. Everybody wanted to answer. Tariq.
Yeah, just very briefly, building on what Jihad has said and the other comments. Yes, countries should not be waiting. They should not be complacent. They should be thinking. They should be preparing themselves. But given the magnitude of the uncertainty and what we see coming and happening, and I do subscribe to the way you framed your intervention, it's a moment of accelerated regime change within the international system, a reconfiguration of everything we've taken in our lifetimes for granted. It's been happening for a while, but now it's accelerating at a pace that is creating a lot of the uncertainty and nervousness. Building on what Jihad said, I would say this is also a moment, especially for countries in the GCC, to rethink regional integration outside of the GCC and beyond even their growing and important integration into supply chains and trade in Asia. This is a moment to perhaps start thinking about Arab economic integration, Middle Eastern economic integration. One of the consequences of tariffs, restructuring of the supply chains, is that trade and supply chains will become much more regionalized, much more localized. That is going to happen in Europe, that's going to happen in North America, possibly that's going to happen in Asia. It should be happening in our region, led by the GCC, for the GCC, but also for neighboring countries. I think the resources, the wisdom, the leadership, and the commonality of views, at least, in wanting to deal with conflicts should give enough of an incentive for the GCC and for the region to respond to this moment of opportunity with renewal commitments to integration. Not the old Arab integration projects, but one that is fit for the requirements of the coming period. Last but not least, I've noticed we have not spoken today, I've mentioned it at all, the future of the dollar. This is one of those times where the future of the dollar is on the table as something to debate, to rethink. Countries in the region and elsewhere are not waiting. They're actually taking steps. They're diversifying payment systems. They're linking up through non-dollar-based cross-border payment arrangements with Asia and other countries. So all is on the table, and precisely, I think, the point you had made of needing to take this opportunity and think through the possibilities, the options, and prepare oneself for the future.
You know, usually it's up for people in TV to leave, to end something with a cliffhanger and a sequel of what's to come. So maybe our next panel can be about the dollar. Panelists, thank you so much. I personally learned a lot from this conversation. Hopefully the audience as well. You had some key takeaways. Thank you for your time. And thank you to DIFC for hosting us today.
Jumana, thank you very much.